As we creep towards the end of the year, there's a lot to talk about when it comes to finances. Joining us now is Chuck Zodda, Managing Partner, Chief Investment Officer from Armstrong Advisory Group. Chuck, thanks for chatting with us today.
Absolutely. It's great to have a little bit of time to chat here.
So for investors who are watching their 401ks, it's been a pretty successful year. Do you see the trend continuing as we look ahead to 2025?
Well, I think one of the remarkable things about this year, even before we get into next year, is just the fact that there's been remarkably low volatility in markets. So even with the gains that we've been seeing, aside from one hiccup in the middle of the year in late July, early August, we really haven't seen much volatility that scared investors very much. And so this leads us into next year, which is where we have investors that are now, looking a little bit complacent, quite honestly. You've got high valuations. You have investors expecting markets to perform very well next year. And that's a situation where, where you can end up with markets potentially having a little bit more volatility if something goes wrong unexpectedly, just because things are priced, not quite for perfection, but for things to go very well in the economy, both domestically and abroad. And so I think that when you look at this market here, it's one where, sure, if things do go as people are projecting, with the U.S. economy continuing to grow at a pretty robust pace, things can obviously turn out fine in markets. But if we see any kind of unexpected pitfall for the economy, whether it's a recession, whether it's a return of inflation, whether it's geopolitical concerns across the globe, these are things that could potentially have an outsized impact given how expensive stocks are relative to the earnings they're producing right now.
Oh, Chuck, while markets have been prosperous, it really runs opposite to what people are feeling when they go to the grocery store. So where do you see inflation going in 2025?
Yeah, so this is one that I think we need to watch pretty closely, simply because even though the headline inflation number, the CPI, is showing that inflation has run at 2.6% for the last 12 months, that's been helped by falling fuel prices. If you look at gasoline prices right now, they're down about 10 to 15% from where they were a year ago. And so one of the things that we'd see in that calculation is there's a number called the core CPI that strips out food and fuel cost, and that's still running north of 3%. And this typically is more indicative of where inflation may settle, simply because gas prices can be so volatile in either direction. And so it does suggest the possibility that inflation may rebound a little bit, not to the rate that it was moving up at back in 2022 when it peaked at 10%. But you might see inflation reaccelerate just a little bit here, and that is something that could potentially be cause for concern, simply because, look, if you talk to people about this economy, we've had something new every year we've had to deal with for the last 4 to 5 years, whether it be COVID, inflation, recessionary concerns. There's been something each and every year that we've had to deal with. This year, it's been a slowing labor market. And so if we do see a return of inflation next year, that could be something that's just another stressor for people in, a series of years where there's been one thing after another that's kind of prevented them from feeling like they're getting ahead financially.
The markets surged just after the election with the Trump victory and a red sweep of Congress. We know that President Trump wants to propose tariffs here. So could tariffs backfire on the U.S. economy if the president decides to do that?
So I don't even know if this is so much a situation where the president would necessarily view it as backfiring. I think that we need to look at this in the context of this is a very different economy that President Trump is inheriting this time around from his first term in office. And based on the chatter that we are hearing coming out of Washington, it certainly sounds like some of the policies that he is proposing and is likely going to move forward with could, in fact, create some very negative situations for the U.S. economy in the short term, with the president having the belief that in the long run, they will provide benefits for the United States. Now, I don't know whether that's going to end up being the case or not in terms of the long-term growth projections, but I don't think this is going to be the same situation that we saw in 2017 during his first term and his first year in office, where it was simply, hey, if I cut taxes, I can see the economy and the stock market surge forward. I think this very much could be a different situation and a different approach that the president is taking here that is much more uncertain in terms of how it may end up benefiting the U.S. overall in the long run. But I think it's a very different approach that we are likely to see in this term as opposed to in his first term.
People watching, maybe hoping for a turnaround in the housing market, even with interest rates coming down, mortgage rates still high, around 7%. Do you think buyers will see any relief in the new year?
I really struggle to see a path towards mortgage rates coming down meaningfully unless the United States ends up in some kind of recession. And the problem then is, look, if you are in a recession, typically unemployment goes up. You have people concerned about their long-term financial stability. And so they often don't make those big purchases like a home or a vehicle. And so it's tough for me to see some significant relief at this point, especially in the New England area, for what we're seeing in the housing market. The big thing that would bring home prices down a little bit would be more inventory coming to market. But it's something that we're just not seeing up here at the moment. Where you are seeing inventory gains, places like Texas and Florida, home prices have actually been coming down in a lot of those markets over the last 12 to 18 months now. But in the Northeast, you still have inventories that are only 25 to 50% of what they were back in 2019 and 2018 when we had more normal housing markets. And so as long as inventory remains tight, pricing is going to remain high, and I don't really see a great path to lower interest rates in the near future unless we see a significant economic slowdown.
Chuck, let's go back to Trump for a second. Crypto Trump bump. Is that likely to continue?
Honestly, I have no idea. The crypto market is very much the wild, wild west. I would be lying if I said I had any insight into what goes on there and exactly how everything moves from a pricing standpoint. So I'll steer clear of that one just because it's not really in my wheelhouse, and I'm not gonna try to get over my skis and extend myself into a place where I'm just not really competent enough to be able to give much insight.
Okay, you and me both. I'm not a crypto queen either. All right, Chuck Zodda from Armstrong Advisory Group. Thank you so much for joining us today, and we'll see you next week.
All right, have a good one.